The falling interest rates is a concern to many retail investors. However, that is a normal situation when the market is adjusting itself. We have reviewed the performance of the money market funds, and here in this video, we are going to review the bond funds. Bond funds, just like money market funds, are collective investment schemes. And the simplest way to understand this collective investment scheme is looking at the fund manager and seeing him as an ordinary aggregator. An aggregator is a professional or a business person who stands in between the producers, here are the savers, and the market. And the market here are the various capital users or the borrowers. And in that view, then, the fund manager approaches the market of the investors and with the promise of having a bargaining or leveraging on the amount that will be pulled together, collects funds from the savers, the retail investors, a person bringing in 100 shillings, 1,000 shillings, a million, 200,000, all those funds are put together in one basket. Then this professional manager, the fund manager, approaches the market in the intention of allocating those monies into various investment vehicles representing borrowers. The government is a borrower. The banks are borrowers for a view of on lending to business people, and that is how we make our money through the collective or mutual funds. For a bond fund, just as the name suggests, these collected funds are merely invested in bonds, or generally it represents fixed income instruments. And these are instruments or vehicles that once the money is invested, they guarantee a fixed return. Not to us as the retail investors, but the fund manager, where he invests these monies, those investments guarantee a fixed income return for a specified period of time. And a good example is the government bonds. We have fixed deposits with banks and investment quality bonds or corporate bonds from listed companies, and in some cases unlisted securities. With a view of that, we would want to look at the similarity between the bond fund and the money market fund, and we also look at the objective of the bond funds, and we shall also be looking at the specific performance of the 9 available bond funds, and we'll also look at the newest kid in the block when it comes to Bond Plus, and this will come after 3 seconds, a short break, so don't go away. In the meantime, as always, give us a like to this video and engage in the comment section. See you after 3 seconds, a short break. Welcome back and thank you for your like and comment. If you are new to the channel, give us your subscription and don't forget to hit the notification button so that when we upload the next value-packed video, YouTube will send you a notification. The first important thing that we need to look at is the bond. Why are we calling this fund a bond fund? And it's because the name bond is used interchangeably with the word fixed income security. So bond funds are merely the fixed income funds. And these are investment vehicles, or these are collective investment schemes that target to invest the collected or the funds into fixed income securities. There is close similarity between the bond fund or the fixed income funds and the money market funds in that the instruments that are targeted by these funds are more or less the same. The only difference between the investments in a money market fund and a fixed income fund or a bond fund, and sometimes also called a bond plus for those that are domiciled in the insurance sector, is the horizon or the maturities of the instruments that are invested in the two funds. Well, for the money market funds, the investments are limited to a weighted average maturity of not more than 18 months, but with the fixed income funds, there is no such limit, and therefore the fund manager can allocate the fixed income funds to investments of whatever maturities horizon as he pleases. That's why in most cases, the fixed income funds will have a higher allocation into government securities as compared to the money market funds, and that is tied to the objective of the two funds. Money market funds normally target to realize the highest possible return in the current market rates, while a bond fund not only looks at the current market rate but also looks into the long term. It averages or leverages on the long term instruments that were taken in at a higher coupons or at a rates to leverage up or to average up the returns of the fund in the long term. The instruments or the available investments or available assets for investment for these two funds, that is the money market fund and the bond fund, are bank deposits. That is to refer to the fixed deposits and the cash or call accounts and demand deposits. Those ones are domiciled in banks, or those are available investments with the banks. The second assets available for investment for these two categories are the corporate papers. And these are the ones that have attained investment quality papers. And that we are talking about the corporate bonds and the commercial papers. And the third one are the treasury papers or government securities. And this is when we are referring to the treasury bonds and treasury bills. In some instances, especially under the money market funds, we'll also get some fund managers allocating a part of the investment to collective investment schemes. So that is what makes a fixed income fund and a money market fund almost similar because they target the same market. That is mostly the fixed income securities, but they are differentiated by the horizons. The monies held in the money market fund go for short term, near cash assets, while the fixed income funds go for both the short term and long term assets. That is, and again, the same reason that makes the qualities or functionality of these two funds the same, or rather, they are giving the investor similar customer experience because just like money market funds, bond funds or fixed income funds will give you the same accessibility. They will also give you the same level of liquidity because objectively, in as much as the fund manager will be looking to maximize the current returns, they also measure to make sure that the two funds are liquid enough, and that's why you can still access your funds from these two investment schemes when and as you need that money, and potentially as per the limitations or the available properties of that particular fund that you're investing into. But averagely, it doesn't take more than 48 hours. The other is a flexibility, and the flexibility refers to that option of you can put in your money anytime, you can also withdraw your money anytime. Then we have a protection, and protection refers to safeguarding your capital against the negative effect of inflation, which eats into the purchasing power of your money. Because these two investment schemes, they purpose to give you a return that compensates the inflation or are slightly higher than the inflation rate, and that one compensates for the value that will be lost on your money over time. The other thing is security. These two investment schemes, the money market funds and the fixed income funds, they are categorized as low risk investment options, and for that reason, there is almost zero chance of losing your money if invested in a fixed income fund, a bond fund, or a money market fund. And lastly, but very important, is that these two investment options, they give us affordability, or what we may also call inclusivity. They they have made investments possible for retail investors or to low income earners. When you look at the current scopes or the available minimum investments, comparing with some few years back when these investment options were a preserve of the rich, as the minimum investments that were expected for these investment schemes were nowhere near what is affordable or available by low retail investors, because we have quite a number of fixed income funds, just like money market funds, that will require a minimum investment as low as 100 shillings, and also for top-ups. And a good example, we have Zimele fixed income fund that transitions from a money market fund to a fixed income fund, and it retained the same features, because generally for any fund manager operating a money market fund and a fixed income fund, you realize that the features of the two funds are merely the same. We also have NCBA fixed income fund that also transitioned from a money market fund to a fixed income fund. We have we have Etika fixed income fund that also takes a minimum of 100 shillings and an equal amount for top-ups. We have Kuza and the others, as we shall be seeing from the schedule in a few minutes. So as a general feature, fixed income funds, they expose you as an investor to a long-term maturing instruments of the nature of fixed income securities. And from this schedule, we are looking at the current performance of the fixed income funds, and it's notable that the Etika fixed income fund has been giving us an averagely 15.24%, which translates to a 12.95% net return. And comparing this return with the Etika's money market return, which also stood averagely at about 13%, would say that there is no much disparity between the money market fund and the fixed income fund, but this one has only been achieved because of the rapid decline in the market interest rates. That is because the money market funds are more responsive to the market interest rates posted by the treasury bills as compared to the fixed income funds, because in the fixed income funds, that pool is holding securities in the bond market that in 2024 were purchased or were invested into realizing higher coupon rates. Remember, we had IFBs of 16.5%, 17.9%, and as the decline continues, because the fund manager is still holding to those instruments, any subsequent investments as market interest rates continue to decline, the fixed income fund pool gets averaged up by the initial investments that were realizing higher coupon rates. But the money market funds, in a short period of time, because the instruments that were invested in the money market funds, they mature in short period of time, then averagely the rates are supposed to come down at a rapid rate compared to the fixed income fund. The transitioning or movement of asset allocations in the money market funds is also more rapid compared to the asset allocations in the fixed income fund, in order to compensate or to shifting the assets in order to compensate for the declining interest rate, and especially when it comes to investment in the government securities. And that one, if you have watched the video, we have reviewed the money market funds, you have noted how much the fund managers shifted their asset allocated to government securities to the fixed deposits with the banks, because the fixed deposits with the banks, the return is based on the CBR rate, while on the government securities is on the market interest rate. While the CBR rate will always be higher than the market interest rate posted by the treasury bills. And that is the reason such funds have been able to sustain averagely higher returns compared to what we are getting from the treasury bills. The second one, we have Kuza fixed income fund that is giving us a 15.05%, that translating to a 12.79%. Madison at 14.23%, that is at 12.10%. We have Zimeles 14.08%, realizing a net return of 11.97%. Britam Bond Plus at 13.70, realizing an 11.65%. Then we have NABO Africa Fixed Income Fund at 13.29%, and that is giving us an 11.30% as net return. COP Bond Fund at 12.72%, net of 10.81%. Then at the bottom we have two, Orient Hifadhi Fixed Income Fund and the NCBA Fixed Income Fund, which have realized a net of a single digit, that is 9.37% and 8.91% respectively. And looking at the net return, when we are looking at the market interest rates posted by the treasury bills, then these two fixed income funds have actually given us a return just the same as what the 1 year treasury bill has posted in the recent auction. And what does that mean to you as an investor in terms of your investment protection? Investments are protected against loss of value due to inflation. But the inflation rates that are posted by the regulator, the current 3.3%, is within the range of 2.5% and 7.5%, which is the normal inflation range in the country. And therefore, as a prudent investor, when you are looking at protecting your investments against inflation, you don't just go for the mere 3.3%, which is the average market inflation rate. Prudently, you're supposed to go for an inflation rate that is higher than that, probably 6% or even the 7.5%, when you are looking at the real market inflation rate that you're supposed to cushion your investments against. And for that reason, that's why as a channel, we always advocate, if you are investing for the long term, if you are in the game for the long haul, then consider going for investment opportunities that are giving you a return that is way beyond 7.5% in terms of net return, and possibly double that figure. So if you are getting like 13%, 14%, 12%, 12.5%, that is a better place than if I'm getting a net return of 9% with a real inflation rate of 6.5%, then that small margin of cushion is not enough protection for my money. Thank you for watching, and see you in our next video.